faithfully delivering value by interpreting great books from around the world. Hi, this is Sally with Book Talk. So today we're diving into a book titled Beating the Street, written by Peter Lynch. Peter Lynch is hailed as the world's best fund manager with 40 years of stock investment experience. From 1977 to 1990, he ran the Magellan Fund at Fidelity for 13 years, boosting its assets from under $20 million to $14 billion with a jaw-dropping average yearly return of 29%. No one on Wall Street could top that. If you'd given $10,000 to Lynch in 1977, by 1990, you'd have $260,000. At age 46, Lynch stepped down from Fidelity and declared early retirement. You might wonder why quit at 46, which is prime time for a fund manager. He just walked away. Look at Warren Buffett, almost 90 and still grinding away. There's a childhood trauma behind this. Lynch's dad died when he was 10, and his father was just 46 at the time. In the middle of his 46th birthday bash, he suddenly thought of his dad. He vowed to stop being a workaholic and make time to raise his 3 girls. After quitting the fund firm, Lynch found time not just for his kids, but also to pen some books. So, if before 46, Peter Lynch was a top-notch fund manager, after that, he pivoted successfully to become a best-selling author. He churned out 3 books. Beating the Street was his second. In this book, he urges amateur investors to gain confidence. Outperforming the pros isn't as tough as you think. He shares a little story. In a suburban Boston school, 7th graders were running a mock stock portfolio. Their stock picks racked up a 70% return over 2 years, beating out 99% of Wall Street fund managers. Now, 7th graders in the States are like our first-year junior high students. Lynch thinks that each person has their own special know-how and experiences. By playing to their strengths and investing in what they know, amateurs can outdo the experts. Some folks might think, since Lynch isn't a fund manager anymore, is he just dissing the pros? Lynch specifically explained this. As he put it, the fund gave him so much achievement and income, and he wouldn't forget his roots. Actually, any investor can buy both stocks and funds. The two aren't conflicting. For someone who doesn't want to put in the effort to research stocks themselves, buying funds is the best choice. And if you really want to take matters into your own hands and enjoy the sense of achievement from picking stocks yourself, then you can succeed too. Lynch's book will guide you through the confusion. Next, I'll break down the essence of this book for you through 2 questions. First question, how did Peter Lynch manage the fund? Second question, what are Lynch's investment principles? Let's start with the first question. How did Lynch successfully manage the fund? Lynch's 13-year fund career can roughly be divided into 3 stages. The first stage was from around 1977 to 1981, when Lynch was just starting out and still figuring out his investment approach. To tell the truth, Lynch's connection with Fidelity Fund Company runs really deep. As we mentioned earlier, Lynch lost his father at age 10. Due to this sudden family change, Lynch started working as a caddy at a golf course from age 11 to earn his tuition. Being a caddy allowed him to meet many big bosses. At the time, his clients included presidents and CEOs of companies like Gillette and Polaroid. Among these people, one had the biggest impact on him, and that was the president of Fidelity Company. When Lynch was in his senior year, he told Lynch to apply for a summer internship. At the time, Fidelity only had 3 spots, with over 100 applicants, and Lynch was lucky enough to get the job. After the internship ended, Lynch went to Wharton Business School for his MBA. In 1969, he officially joined Fidelity Fund Company as a securities analyst. 5 years later, Lynch was promoted to research manager, and in May 1977, he started as the manager of the Magellan Fund. At that time, the fund size was around $18 million. For the first month after Lynch took over, he was busy selling the stocks picked by his predecessor and buying those he favored. In fact, at that time, Lynch didn't have a comprehensive stock picking strategy. He said that his stock picking was entirely based on experience, and Lynch changed stocks frequently with an annual turnover rate around 300%, often resulting in selling good companies and buying bad ones. Lynch joked at the time that he was pulling out flowers to water weeds. Buffett really loved this golden quote from Lynch. He even cited it in his company's annual report. From Lynch's early experiences, fund managers aren't gods. They make mistakes in investing too. But the key is to learn lessons and avoid repeating similar errors. Later, Lynch reflected on this. He realized he sold some stocks too early after holding them for just a few months, when he should have held them longer. For example, FedEx was bought at $5 a share. Soon, the price rose to $10. Lynch happily sold it off, only to watch helplessly as the stock soared to $70 2 years later. The second stage of Lynch's fund career was from 1981 to 1983, during which he gradually developed his own investment style. In 1981, the fifth year of Lynch's tenure, the Magellan Fund was still quite small, with only $100 million, ranking in the bottom 5 among all investment funds. And at that time, Lynch's portfolio had 200 stocks. 2 years later, in April 1983, the Magellan Fund grew to $1 billion, a milestone. Then, the Magellan Fund held 450 stocks. By the fall of that year, the number doubled to 900. We know that holding more stocks means spending more time researching them. Fortunately, by then, Lynch had several very capable assistants to help share the load. Actually, Lynch was famous on Wall Street for holding a huge number of stocks, peaking at over 1,400. But a big chunk of these were just trial buys. For instance, when he held 900 stocks, 700 of them combined accounted for less than 10% of the fund's total assets. So why buy these 700 stocks? Lynch's answer was that, first, many companies have very small market caps, what we call small cap stocks. So even at the 10% ownership limit, the capital used was tiny. Another reason was that he wasn't sure if the stock deserved a large-scale investment. So he'd buy a little to observe first, see how it goes. For us ordinary investors, it's impossible to buy hundreds of stocks just to test the waters. So we can follow Lynch's approach by using 10% of our principal for such trial investments. For example, if you invest 200,000 yuan in stocks, you could allocate 20,000 yuan for experimental purchases. From 1981 to 1983, during Lynch's mid-period managing the Magellan Fund, he played it safe and steady. The fund's annual turnover rate dropped by nearly 2/3, from 300% to 110%. At this stage, Lynch became a more patient investor, and Magellan fund holders grew more confident in him. And the third stage of Lynch's fund career ran from 1983 until his resignation in 1990. During this time, Lynch matured through experiencing stock market crashes. By end 1983, the Magellan Fund's assets hit $1.6 billion, becoming America's second largest fund. And it was very close in size to the top fund. In 1984, Magellan saw red-hot subscriptions adding another $1 billion. Actually, throughout 1984, the fund's top 10 holdings remained largely unchanged, a shift from Lynch's earlier frequent trading. His steadfast strategy became selecting individual stocks and holding them long-term. Most fund managers gamble on industries, prioritizing sector allocation over stock picking, like planning to invest 8% in auto stocks, then picking specific companies almost randomly. Lynch focused intensely on individual stocks, using bottom up selection. About buy and hold, he explained. Choosing stocks is like choosing life partners. Make a wise choice early, and you won't plan a divorce. For instance, Ford, Chrysler, and Volvo were his heavy holdings from 1982 to 1988, 6 full years. His strategy earned over $100 million each on Ford and Chrysler, and $79 million on Volvo. After 1983, though, Magellan grew massive. It didn't become mediocre. It dominated Wall Street as a top-tier fund. By 1987, Lynch planned to retire victoriously. In August, Magellan's assets reached $11 billion. But then October came with the U.S. stock market crash, shrinking the fund to $7.2 billion. He couldn't leave during such a crisis. As Lynch put it, the crash practically forced him to stay. When the market crashed, Lynch was vacationing in Ireland playing golf. We can imagine that vacation wasn't relaxing for Lynch. Back then, many panicked investors rushed to redeem their funds. To handle this, Lynch had to massively sell off the fund's holdings. Fortunately, most fund holders stayed through the crisis, teaching Lynch that a fund's success or failure depends heavily on its investors. Fund holders play a crucial role if they confidently hold during crises rather than panic redeem. Managers won't be forced to sell at rock bottom prices. Lynch also admitted being nearly fully invested during the crash, leaving no cash to handle redemptions, a warning for amateurs to always keep some flexible funds. Post-crash, Lynch bought financial stocks and heavily increased positions in insurance, pharma, and defense sectors, quickly turning losses around. But throughout Lynch's 13-year tenure, Magellan consistently outperformed the average stock fund. When Lynch resigned in 1990, Magellan's assets reached $14 billion, with $1.4 billion in cash, about one-tenth. Clearly, the 1987 crash taught him to keep 10% cash reserves against unexpected events. The above gives a brief review of Lynch's 13-year career and its brilliant achievements. Behind it all, Lynch poured immense sweat and dedication. He visited over 200 companies annually and read 700 corporate reports. Over 13 years, Lynch's investment philosophy matured step by step. Early on, he frequently traded stocks, often selling good ones for bad. Later, his strategy of carefully selecting individual stocks to buy and hold brought substantial profits to the Magellan Fund. Now, let's move to the second question. What are Peter Lynch's investment principles? If stock selection is divided into technical analysis and fundamental analysis, Lynch's approach is purely fundamental analysis. So, this book contains no technical indicators, just simple balance sheets. Even stock charts are rare. To Lynch, stock picking is art, science, and research combined. The art refers to intuition, a kind of ineffable inspiration, and the science means quantitative analysis of company financial reports. Stock picking is both science and art. Overemphasizing either is dangerous. Lynch stuck to art science research for 20 years, never wavering. Lynch always believed finding good stocks is like looking for bugs under rocks. Turn 10 rocks, maybe find one. Turn 20 rocks and you might find two. As fund manager, he turned thousands of rocks yearly to find enough bugs. But for amateurs, Lynch says you don't need 50 to 100 stocks. Finding 2 or 3 big winners in 10 years makes the effort worthwhile. Small investors can use the 5-stock rule, limiting portfolios to 5 stocks. On one hand, spreading eggs across 5 baskets mitigates risk. On the other, if one of those 5 becomes a big winner, even if the other 4 don't rise, the portfolio can still be profitable. Lynch had an old school but effective investment recording method. We can learn from this. In today's digital age, few write by hand. But Lynch meticulously recorded every stock picking process in a big notebook. As he said, it prevented him from forgetting old loves when finding new flames. Um, we've all experienced this. Stocks don't rise while we hold them, but soar right after we sell. We faithfully delivering value by interpreting great books worldwide. Hi, this is Sally with Book Talk. Today, we're diving into a book titled Beating the Street, written by Peter Lynch. Peter Lynch is hailed as the world's best fund manager with 40 years of stock investment experience. From 1977 to 1990, he ran the Magellan Fund at Fidelity for 13 years, boosting its assets from under $20 million to $14 billion, with a jaw-dropping average yearly return of 29%. No one on Wall Street could top that. If you'd given $10,000 to Lynch in 1977, by 1990, you'd have $260,000. At age 46, Lynch stepped down from Fidelity and declared early retirement. You might wonder, why quit at 46, which is prime time for a fund manager? He just walked away. Look at Warren Buffett, almost 90 and still grinding away. There's a childhood trauma behind this. Lynch's dad died when he was 10, and his father was just 46 at the time. In the middle of his 46th birthday bash, he suddenly thought of his dad. He vowed to stop being a workaholic and make time to raise his 3 girls. After quitting the fund firm, Lynch found time not just for his kids, but also to pen some books. So, if before 46, Peter Lynch was a top-notch fund manager, after that, he pivoted successfully to become a best-selling author. He churned out 3 books. Beating the Street was his second. In this book, he urges amateur investors to gain confidence. Outperforming the pros isn't as tough as you think. He shares a little story. In a suburban Boston school, 7th graders were running a mock stock portfolio. Their stock picks racked up a 70% return over 2 years, beating out 99% of Wall Street fund managers. Now, 7th graders in the States are like our first-year junior high students. Lynch thinks that each person has their own, special know-how and experiences. By playing to their strengths and investing in what they know, amateurs can outdo the experts. Following this logic, we can find similar stocks in the A-share market. For example, Wuliangye just needs a liquor bottle drawing, Fuling Zakai a pickled vegetable packet, Gailey Auto a car. These companies have dead simple businesses that are easy to grasp. Next, our second rule, stocks you're bullish on won't necessarily rise. Know when to swap them out. Lynch's lesson came from what he called the shattering of a foolish fantasy. In 1977, when he first took over Magellan, the broader market plunged 20%. But against the trend, Magellan's net value actually rose 7%. This success made Lynch overconfident. He thought his picks would soar no matter what. But then came the next major correction. From September 11th to October 31st, 1978, his fantasy shattered completely. The market fell hard, but Magellan fell harder. This wake-up call taught Lynch his picks wouldn't always rise. When things sour, swap stocks promptly. By the 1987 crash, he didn't repeat that mistake. Pre-crash, the market was hottest on cyclical stocks. With cyclicals, timing is everything. Miss the rhythm and fail to cash out, good stocks turn rotten. Take Chrysler. After market stabilized, it rebounded from $20 to $29 per share. But 3 years later, in 1990, it crashed to $10, nearly half its 87 price. Seeing Chrysler's performance nosedive, Lynch sold all his holdings. He also turned bearish on paper, chemical, and steel cyclicals. Post-crash, oversold bargains were everywhere. Lynch dug up growth stocks instead. This portfolio shift proved brilliantly successful. In 1988, Magellan delivered 22.8% returns. In 1989, 34.6%. Like Lynch, we cling to favorite stocks, believing they'll rise despite red flags. Sometimes only losses wake us up. For example, everyone knows the joke about scallops escaping, referring to Jean Zigao. When this company first listed, many investors had high hopes. Its stock peaked around 35 yuan in 2010. But later, the company faced constant issues. In 1914, they announced farmed scallops escaped, causing massive losses and an ST designation. In 2018, their scallops escaped again, crashing the stock to just over 3 yuan. If you don't swap stocks when situations change, clinging to initial enthusiasm, losses can be huge. Next, let's discuss Lynch's third investment rule. If you love a company's store, you might love its stock too. We call this the love the house, love the crow rule, like with the Body Shop. This stock was discovered entirely through Lynch's daughters. One store was in Burlington Mall. When Lynch took his daughters shopping, they rushed straight to the Body Shop, specializing in cosmetics and skincare. Lynch saw the store jam-packed with shoppers. At checkout, he recalled an analyst recommending this stock at a Magellan Fund meeting. Coincidentally, the franchise owner was Fidelity's former data chief. He'd quit his lucrative job to open it with savings. Back home, Lynch checked his thick notebook and found he'd bought this stock in 1989. It was just a trial buy then, but somehow he'd forgotten. This London-listed stock suffered two crashes, one during 1987's market crash, having its value, the other during the U.S. invasion of Iraq, having it again. But by 1990, 6 years later, the Body Shop surged from 5 pence to 362 pence, delivering 70 times returns if held. Another love the house, love the crow example. The 1960s U.S. restaurant boom. Restaurant stocks are a bright spot in the U.S. stock market, with McDonald's seeing the highest gains. If you bought McDonald's stock because you love their burgers, you've made a killing. Say you invested $10,000 in McDonald's stock back then. By the 80s, your net worth would have reached at least $4 million. Around us, such foodie stocks are too numerous to count. We can also pick stocks from our favorite restaurant companies to buy. That's all for the third rule. Next, we'll discuss Lynch's fourth investment rule. When analysts are bored, that's the best time to buy. We know that if analysts don't favor an industry, there probably aren't any good stocks there. But when it comes to such industries, Lynch can find a unique path, digging treasures from these depressed industries. Lynch's real estate stocks were uncovered this way. By the end of 1991, U.S. investors were most fearful of real estate-related listed companies. But Lynch found it in the back pages of a newspaper. In an inconspicuous message, he saw that U.S. median home prices were rising, leading him to uncover a home builder, Toll Brothers, and related companies like Sunbelt Gardening, which later yielded hefty returns. Years of experience helped Lynch formulate a highly effective investment strategy. When media and analysts widely believe an industry has deteriorated to a very poor state, boldly buying the strongest companies in that sector will surely make you money. This is what we often call buy when others are selling. Of course, being a bag holder must be based on reason, not blindly rushing in. We know that after all bad news is out, it turns positive, but if bad news keeps coming, it's not yet time to buy the dip. Or if the industry is obsolete, you shouldn't be the last bag holder. Don't forget, Lynch also said, never bet on a company about to go under, hoping for a miraculous revival. These 4 investment rules we've discussed are all distilled from Lynch's years of experience. I hope this inspires you so picking stocks doesn't feel so hard in the future. Go shopping or eat at a restaurant, Maybe the next big winner is right under your nose. We can also focus on niche industries. Any stock rebounding from rock bottom with positive news deserves attention. Stocks others avoid investing in offer chances for extraordinary profits. Lynch offers another valuable insight. Monopoly always outperforms competition in markets. When bullish on an industry, prioritize listed companies with monopolistic positions. Well, as Lynch said, amateur investors leveraging their strengths through independent analysis can seize stocks ignored by pros and reap excellent returns. All right, that concludes our interpretation of Beating the Street. Reading notes are below the audio. See you tomorrow.